Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Right now, we have a stock market that is basically engineered from the ground up to make you wealthy.
Right.
But, and this is the paradox we're exploring today, millions of everyday American investors are actively using it to go broke. So this deep dive is all about that exact trap. We're going to look at the data to see how people are taking this massive machine built for wealth creation and just accidentally turning it into a total financial trap.
Yeah, I mean, sitting here in 2026, the barrier to entry has truly never been lower. Anyone can access global financial markets from their smartphone while they're just waiting in line for coffee.
Which is amazing, but also terrifying.
Oh, it's a huge double-edged sword.
Eba.
Because that incredible accessibility means behavioral traps are also just a tap away. So we really need to separate the fundamental act of investing in a real business from, just speculating in a digital casino.
Because right now, those two things look identical on the screen.
Exactly. They happen on the exact same apps, and the line between them has just never been blurrier.
Right. So to understand how everyday investors kind of break the game, I think we first have to look at how the engine of the game is actually designed to work in your favor.
Right, the positive sum environment.
Yeah, exactly. When a system is positive sum, it basically means the pie itself is getting bigger. Let's use an everyday analogy for anyone who's a beginner to this. Think of a local bakery.
Okay, I want to go.
If you buy a small ownership stake in that bakery, which is essentially what buying a stock is, you are participating in a real-world economic process, right?
Yeah.
The bakery buys flour, they bake croissants, they sell them at a profit, and maybe they do so well they open 3 new locations.
Right, and because the bakery is generating actual new value, the value of your piece of the pie goes up.
Exactly. Wealth is created for everyone involved. That's a positive sum game.
But contrast that with standing on the sidewalk outside that exact same bakery and betting a stranger $10 that the bakery will run out of croissants by noon.
Right. Totally different scenario.
Completely different. If they run out, you win $10 and the stranger loses $10. Zero new wealth was created.
The pie didn't get any bigger.
No, money just transferred from one pocket to another. That is a zero-sum game. And when you look at the underlying data for the broader stock market, that positive sum engine is very clearly what drives long-term returns. I mean, take the recent analysis from mid-June 2026. Wells Fargo actually raised its S&P 500 target to 7,950.
Which is just a massive target, but it's not a number they just pulled out of thin air?
No, not at all.
Okay.
It is entirely tethered to real output. That target was backed by their expectation that overall earnings per share, so the actual profits these companies make, will rise to $340.
Okay, well.
Yeah, that underlying profit growth, companies collectively selling more products across the economy, that's the positive sum reality. When you buy a broad index fund, you're capturing that fundamental growth.
But when you move over to derivative products, things like futures or short-term options, you're stepping right back into that zero-sum territory.
Exactly. You are just betting the stranger on the sidewalk again. And honestly, because you have to pay the broker to facilitate that bet, it mathematically becomes a negative-sum game for the average person.
Right. The house always takes a cut. But let me push back a little on this idea of the market being just this unstoppable positive sum engine.
Sure.
Because if we look at the macroeconomic landscape right now, under the current Trump administration in 2026, it's a really complex environment. Aren't the historical tailwinds like constantly falling interest rates or baby boomer money, aren't those starting to fade? The market doesn't just magically go up forever.
Oh, I agree completely. The market is definitely not some magical upward escalator.
Yeah.
High interest rates, stretched valuations, geopolitical tensions, all of that can cause the stock market to stagnate for years.
Right.
But the vital distinction is that even during a decade where stock prices stay perfectly flat, those underlying businesses are still churning out dividends. They are refining their productivity. The structure of owning a productive asset is still positive sum.
Even if the share price isn't exploding upward.
Exactly. Whereas derivatives lack that internal growth mechanism entirely. Interestingly, if you look at CME Group, they run some of the largest derivatives exchanges. They reported massive profits in early 2026.
Because everyone is trading derivatives.
Well, yes. But analysts noted that the sustainable volume comes from massive institutions using derivatives to hedge real business risks.
Oh, like an airline locking in jet fuel prices for the next 3 years so an oil shock doesn't bankrupt them.
Precisely. They're managing supply chain realities. They aren't treating the derivatives market like a roulette wheel. But unfortunately, a huge segment of retail traders right now are using those exact same complex instruments to just blindly guess the market's direction.
So, if the underlying engine of the stock market is positive, everyday investors are essentially losing money by constantly tinkering with the engine.
That's a great way to put it.
And looking at the data, the main way they do this is through frequent trading on so-called free apps.
Oh, the free trading illusion. It is arguably the most expensive illusion in modern finance.
Right, because people think, hey, there's no $10 commission fee anymore, so it doesn't cost me anything to buy and sell 10 times a day.
But according to the SEC, there are hidden costs embedded in every single transaction. It acts like a leaky bucket.
Like the bid-ask spread.
Exactly. Whenever you buy a stock, there is always a slight difference between the highest price a buyer will pay and the lowest price a seller will accept. The market maker takes a tiny fraction of a penny on that spread.
Which feels completely invisible to the user. You just hit buy, your order fills, and you don't get a receipt showing that you lost a fraction of a percent to the spread or to slippage.
Right, but if you trade constantly, those fractions add up to a massive drag.
I always like to use this analogy. Imagine planting a tomato seed in your garden.
Okay.
If you just water it and let the sun do its thing, it grows into a huge plant. But if you dig up the seed every single day just to check if the roots are growing, that constant stress and friction is going to kill the plant.
That is exactly the mechanical failure we see in overactive portfolios.
Mm-hmm.
And, the damage actually goes way beyond just the immediate transaction costs.
Because of the lost compound interest.
Spot on. When a few drops of water fall out of your leaky bucket to cover the spread or taxes, you aren't just losing those dollars today. You are losing the exponential growth those dollars would have generated over the next 20 years.
Let's really unpack the scale of that compound loss, because there's this landmark study from the Haas faculty, the Barber and Odin study.
Yes, incredibly famous study.
They didn't just look at a few traders. They analyzed the brokerage records of over 66,000 households to see how trading frequency actually impacted their wealth.
And the findings are just devastating for the active trading mindset. They divided those households up based on how often they turned over their portfolios.
Okay.
The most frequent traders, the ones always jumping in and out, trying to time everything, they earned an average annual return of 11.4%.
Which honestly, in a vacuum, making 11.4% sounds fantastic.
But you'd be thrilled until you look at the control variable.
Yeah.
The broader market returned 17.9% over that exact same period.
Wow.
Yeah. By constantly tinkering, the most active traders gave up roughly 6.5% in returns every single year.
And over a 20-year horizon, giving up 6% annually doesn't just mean a slightly lower balance. Because of compounding, you end up with hundreds of thousands of dollars less for retirement.
Exactly. And the researchers made a really clear point. These traders didn't lose because they were unintelligent or lacked information. They lost because of overconfidence. They really believe they can outsmart the market by acting quickly, and those hidden frictional costs just bled them dry.
Frequent turnover is the enemy of compound growth.
Always.
Which really brings us to the unique danger of where we are right now in 2026. Because if frequent trading destroys wealth, this current environment is perfectly engineered to tempt you into doing it.
Oh, absolutely.
I mean, it's like handing the keys of a Ferrari to a teenager with a learner's permit. We have this explosive mix right now. Massive technological optimism around AI combined with highly accessible, wildly risky financial products right on your phone.
The gamification has reached critical mass. Just look at the data. In 2025 alone, retail inflows jumped 53% to over $270 billion.
That is a staggering amount of money.
It is. Everyday people now make up roughly 20 to 25% of all daily market trades. And the regulatory environment actually cleared the path for a lot of this.
Yeah.
In April of 2026, the SEC relaxed the old pattern day trader rules.
Those were the rules that stopped small accounts from rapidly buying and selling on margin, right?
Right. And relaxing them sparked this massive wave
Yeah.
of impulsive YOLO trading.
And the specific instruments they're using are what's really terrifying. People aren't just day trading normal shares of, like, Microsoft. They are using single stock, leveraged ETFs, and zero DTE options.
Yes. The leveraged ETFs are huge right now. And the trap there isn't just the leverage, it's the daily structural reset. The mechanics practically guarantee you will lose money in a sideways market.
Because of volatility decay.
Exactly. It's arguably the least understood risk in the retail market.
Let's walk through the math on that because I think
Right.
people really need to hear how this works.
Right.
Let's say you buy a standard stock at $100.
Okay.
The market has a terrible day and the stock drops 10%. So it's down to $90.
No.
Then the next day, it rallies. It goes up about 11%, bringing it right back to $100.
So the stock went on a wild ride, but basically broke even. Your capital is completely intact.
Right. But what happens if you use a 3 times leveraged ETF for that exact same scenario?
Well, on day one, the underlying stock drops 10%, so your leveraged fund drops 30%. Your $100 investment is now $70.
Ouch.
Then on day two, the stock goes up 11%, so your fund goes up 33%. But a 33% gain on your new $70 balance only brings you up to about $93.
Wait, really? So the underlying stock completely broke even, it went right back to 100. But just because you held the leveraged ETF for 2 days, you permanently lost 7% of your money.
Yes, it just evaporated into the structure of the fund. That is volatility decay.
Huh.
Over time, wild market swings will quietly destroy your capital from the inside out, even if the stock you bet on eventually goes up.
That is wild. And yet, Reuters reported a massive surge in these exact products in early 2026.
Oh, they are everywhere. There are 355 of these single stock leveraged ETFs now, and 275 of them launched just since January 2025.
Wow.
And the craziest part, retail investors drive nearly 90% of the trading volume in these funds.
No wonder Federal issued that severe warning in June 2026 about the extreme dangers of day trading on margin.
Exactly. But honestly, the zero DTE options might be even worse.
0 days to expiration. So these are options that expire literally in a matter of hours.
Yes, it essentially turns the market into a casino probability game where time is literally working against you. When you buy an option that expires at 4 p.m. today, you're not investing in a company. You're buying a lottery ticket that is actively catching fire in your hands.
Because every hour that passes without a huge price swing, your money just disappears.
Exactly. The time premium evaporates. And doing this right now is exceptionally dangerous because the 2026 market is so dual-sided.
Right, because on one side you have analysts like that Reuters poll from late May projecting the S&P to hit 8,050 by mid-2027. Corporate profits look strong because of all the AI data centers.
The positive sum engine is humming.
But at the exact same time, you have the Fed. Fed Chair Warsh delivered that really hawkish pause on interest rates on June 17th.
Right, which sent bond yield spiking and completely rattled the stock market. You have this intense tug of war between booming tech and tight monetary policy.
Meaning the market is guaranteed to be incredibly volatile. And if you drop highly sensitive leveraged instruments into a volatile environment,
The volatility decay will absolutely shred your account.
it's like trying to predict the weather by looking at a spinning coin. So if chasing these gamified apps and leverage is the ultimate trap, what is the actual winning move for a beginner investor?
Well, counterintuitively, the data shows that the most profitable skill you can develop is learning how to do absolutely nothing when you are the most terrified.
The power of doing nothing. Let's look at the data on that because the Hartford Funds study on this is just staggering. They looked at 30 years of data from 1996 to 2025.
Right, and they wanted to find out exactly when the stock market's absolutely best single days occurred.
And the results go against every human instinct.
Completely. The data showed that 76% of the stock market's absolute best days happen either deep inside a bear market or during the first 2 months of a brand new bull market.
Basically, before anyone even realizes the trend has changed.
Exactly. 76% of the time, the market makes its biggest leaps upward when the economic news feels the most terrifying.
Let's visualize that. Think about the market crash in March 2020 or the depths of the 2008 crisis. Every headline is screaming about total economic collapse.
Right.
The human instinct is to panic sell, retreat to cash, and wait for the dust to settle. It's like jumping out of a roller coaster right as it hits the bottom of the track. You take all the damage, but you lock yourself out of the park before the fun part starts again.
That is a perfect way to describe it.
Yeah.
Because the rebound is always sharp, sudden, and completely unannounced. And Hartford quantified exactly how much it cost to miss those sudden rebounds.
Okay, what were the numbers?
If you invested over that 30-year period, but you missed just the 10 best days, 10 single trading sessions out of over 7,000 prints, your total long-term returns were cut in half.
Wait, seriously, just 10 days cost you 50% of your wealth?
Yes, and it gets worse. If you were sitting in cash waiting for things to calm down, and you missed the 30 best days over 3 decades, your overall returns plummeted by 84%.
Wow.
The penalty for trying to time the market is just catastrophic.
But let me clarify this because I don't want people thinking we're telling them to just bury their head in the sand. Are we basically suggesting an investor should just close their eyes, ignore their portfolio, and just do absolutely nothing forever?
No, no, it's a vital distinction. True long-term investing isn't abandonment. It is adhering to a very disciplined set of rules. Doing nothing in response to market panic is actually a highly active and difficult psychological choice.
Right.
A successful investor engages with their process, not the daily price action. They set target weights based on their risk tolerance. When the market swings and those get out of balance, they systematically rebalance. They manage taxes.
They only make a moves when it mathematically improves their long-term return.
Exactly. They absolutely do not touch their portfolio just because they got panicked by a Fed headline or because someone told them about a shiny new AI fund.
Let's bring all this together. We've covered a massive amount of ground today, and I think the core takeaway from all the analysis is incredibly empowering, but it does require real discipline.
Absolutely.
The market is not a casino designed to take your money. It's a positive-sum engine powered by real corporate growth, dividends, and productivity. If you just buy pieces of great businesses and let the market do its job, the math is structurally designed to make you wealthy. But millions of people are voluntarily opting out of that winning game. They let zero-commission apps trick them into overtrading. They bleed wealth through hidden spreads. They play with zero-DTE options. And they use leveraged ETFs that mathematically eat their own capital.
Yeah, they're turning a winning game into a losing one. And if there's one specific provocative thought I'd leave you with to mull over this week, it's this. Take an honest look at your own portfolio.
Yeah.
Ask yourself, are you truly acting as an owner, holding on to pieces of great businesses to capture their long-term growth? Or have you accidentally let the gamification of the market turn you into a speculator, where you're essentially just renting price action for a few days at a time?
Because recognizing the difference between those two things is what separates the people who build real wealth from the people who just generate fees for Wall Street.
Exactly right.
Don't forget to subscribe and hit that like button.